Hey, how you doing? And welcome to Buy or Sell. I'm Ali Selby. Who the hell am I? Well, I'm a former finance journalist turned finance girly who recently moved to the dark side, and now I'm working in funds management. Over the next few weeks, I'm going to be interviewing some of the best investment minds in the country so that you can get your portfolio looking a hell of a lot hotter in time for summer. This week, I'm very lucky to be joined by the very fabulous Jun Bei Liu from 10Cap. We're going to be diving into the stock she's loving today, as well as a few of her shorts. Thanks so much for joining us today, Jun Bei. Really excited to have you on the show. I know you've recently started your own shop, 10Cap, after 20 years with Tribeca. Very, very quickly, what's that been like?
Look, most of the time it's been exhilarating because, we're 7-people team and all we focus on is just one fund. We're very agile, we can move. Now, the rest of the time, the small part of time, sometimes it's terrifying. As you know, funds management, performance is everything. We have really good long track record, very good, very strong against the market. However, during the first year, it's always very important. And then we were going red hot in January and then sail straight into the Liberation Day. And no one expected that sort of volatility, but you know what? We pulled it through. Phew.
Yeah, thank God, thank God. What makes your strategy unique for those who don't know that much about you? What are you looking for on the long side for stocks? You're also a long short fund, so what are you also looking on the short side as well?
Yeah, what's unique is that we have extra tools we can use. So as you mentioned before, we can actually short companies. So if we think the share price is going higher, we buy them. And if we think the share price is going lower, we can short them. And then when we short a company, we'll get the extra cash and we buy more of the companies that we love. So what do we look for? So for a good company, it's essentially the same on the long versus the short. So with a good company, management, track record, good business model, good franchise, and execution and addressable market as well for some of the growth companies. So that's incredibly important. For the short side, it's a little bit different because, when you short a stock, you have to be very, very laser focused on some of the catalysts coming up. So what do we mean by catalysts? As in, if we short, we need to know exactly how much return we expected and within 3 months or maybe it's 1 month, what is that event that's coming up going to realize that return? Otherwise, company just doesn't go lower unless there's a catalyst.
So you're not really shorting on valuation grounds then?
Yeah, shorting on valuation ground is very, very difficult, especially for the Australian market. Just because something's expensive doesn't mean it's going to get cheaper. Only thing will make it cheaper is when their earning isn't up to scratch.
Okay, let's get into buy or sell. I know from your recent investor update that you're really loving the cyclical players right now. Can you tell us what you're buying in that space?
Yeah, so with the interest rate cut and the like, we're already seeing our economy sort of picking up a little bit. So cyclical, we're talking about property trust companies. They have leveraged to lower interest rate. So within that space, we like the Stockland, we like the housing related. There's a new company just listed called GemLife. They provide the retirement living and it's a family business. They've been doing it for generations and then they're really, really good at what they do. So that's a new business. We leverage to that. Also, with lower interest rate, we talk about, sectors that's benefiting from that. That's retail companies, that's, housing related. And the housing related, of course, the likes of the REA.com. You've got, other building material businesses like the Boral, which is a 7 Group. And then the retailers, there's a whole bunch of housing related. We love the Harvey Norman. JB Hi-Fi is one of the core holding. And more recently, we added the likes of Universal. It's not so housing, but teens are really spending in their stores.
Sorry, Universal Clothing Store.
That's right, yeah.
Wow, okay. So what are you seeing for that stock?
Oh, that stock is actually very, very cheap. Being the smaller cap company, actually this is one of the opportunity we're seeing now. The small cap is where all the opportunity is in the current market. It is very cheap. It's on 16 times earnings and it's growing double digit. And one of the best thing about buying a retailer is that you want to buy the store rollout story. They're actually rolling out a lot of stores every year, adding to the growth. At the same time, every store is people are spending more and they seem to get that teen trend right. Even my daughters love to visit their store. So that is the one that's going to be a stellar performer over the next 12 months.
Okay, talking about cyclical players, I know that you're also liking resources right now, exposed to the China recovery. Can you tell us what you're buying within that space?
Yeah, so within resources, very interesting. If you want, so we are playing the China recovery. Things are doing a little bit better in China. So the iron ore names is the easiest way to play. But we do have a preference for BHP over here. I know it's really boring, the biggest company, but the share price being sort of impacted somewhat because of the recently, China stopped some of the cargo and the like. But that company has over 40% of its earning from copper, and it's not valued nowhere near what other copper company has done. So we believe that's a better way to play in terms of the China recovery. But we also, as one of our long-term holding is A2. A2 has been an incredible growth company in that market, despite how tough it's been because of the marriages has been down and consumer gone through really tough periods. Now, finally, China consumer seems to have turned the corner. And A2, with many years of investment in that space, has now really penetrated into, pretty much down to the tier 3 cities. This is just an incredible growth story. And now that with the, babies numbers turning, we do think that upswing could be quite significant.
On the other side of that, I know you're shorting a more defensive name, being the ASX. What's the thesis there? What happened?
Oh, look, with ASX, it did seem right before the reporting season, probably around July, June and July, we looked at the performance across, most of the defensive names. So we don't actually just go and find the defensive companies to short, really looking at companies' earnings. And then one thing we are certain was that getting into the result, share price was, trading at significant almost all-time high, and with a big multiple. I think it was trading on 27 times the earnings of an earning that is, people still expecting, a couple of % growth. We just thought that looks way too expensive for the earnings that's very low. At the same time, they have a lot of issues with ASIC,
Yes.
and they've been investigated. So usually post those investigations, it usually means remediation, and that means high cost. And regardless, you need to have more compliance. You need to add a lot more, costs operationally, that's going to be disruptive as well for the business. So, for us, it was quite an easy short into the reporting season where it's expensive, had a good run, earnings about to have some issues, and that's it ticks every box for sure. So, we were fortunate literally within days, and they did have a profit warning that the earnings will be low and the like. So, it's become a bit cheaper now, but still seems to be very, very challenged. They need to move past this regulatory issue. I think the right thing for them to do is just to speak to the regulators, work out the remediation, and then move on from there. After all, still a very monopolistic asset.
It has sold off quite a lot over the last few weeks. Have you closed out that short yet, or are you thinking about that, or you still think there's further to go?
Look, we actually think it's not a short anymore. At this level, when I buy it, might be might you have to wait for a little bit
Probably
longer.
Not.
Yeah, I actually think at this point, equity market, we all know that, for people listening to this, equity market activity has been incredibly strong in the last couple of months. We had a lot of issuance, we had a lot of market activity. Many stockbrokers had their best month ever, in the last decade, just in August. So, so the activity is really strong and usually means the ASX does benefit. And, with the share price collapse in the last month or so, it does look like the earning may be stabilizing. So, it looks interesting from this point.
Is there anything else that you'd be willing to share that you're shorting right now?
I think at this point is usually a little bit guarded with the shorts. I think at this point we are rotating our shorts now because we did have previously have a lot more short sitting in the resources space, and now we're moving out of it from 3 months ago because the market conditions turned. For example, lithium was a good short up until sort of June, and now with the market changing where it is, it's becoming a little bit more volatile. So again, we're looking at again in some of those expensive defensive space. Woolworths was a short, but now sort of come off quite a lot. I'm not sure if they can actually turn around the business that fast. We all know these things take a really long time. They may still be the underperformer. So when we play long short, we tend to have long on the other side as well. So playing calls
like a
against
pairs trade.
That's right. So this is the best pair trade we can find. But when we can't find it, if we think that fundamentally it's going down like ASX, we'll still short it.
Okay. Speaking of expensive things, I know that you love structural growth players. What are you buying right now in that space?
So in the structural growth space, I think we actually saw quite a few underperformers, interestingly, since beginning of the year till now. Of course, some of our smaller ones have done well, the likes of, Zip, 360 done really well. But if you go under the hood, go the level down, if you look at REA, actually hasn't done much so far this year because the fear of the CoStar coming in. Now CoStar has now spoken to quite a few investors about what their plans are, but it doesn't seem like the initial fear about total discount trying to get market share. It's more about use this as a hub and then grow other markets around here. And also speaking to REA, they have researched deeply about what CoStar have done overseas. I'm confident that they will be able to defend the market share. I think the market condition is definitely improving as well. So for this one, I think I'll put we've been buying a lot more of it. I think once the housing market, the listing start turning in spring, now heading into we're actually in spring now, that company will become very, very leveraged. 3 months ago we bought Seek because we've been building stake in Seek. Now share price started improving, but I think with the job market improving as the way it is, again they come upgrade. So you want to buy companies that earnings being upgraded, and valuation should be secondary.
I want to jump back to what you were saying before. You spoke about Zip and Life 360. They've run really, really hard. Have you been trimming there, or you think there's still more to go?
I definitely think there's still more to go, but I think in a portfolio context is that because we are seeing more opportunity in the smaller ends and also in the cyclical part, the retailers and others, we do need to sell something to make room for those. And so in our growth bucket, which we always have part of the portfolio for growth bucket, we've just been trimming, taking a bit of profit here and there. But these companies, the structural growers, will always form a very, very important part of our portfolio. But it just, at times that we kind of just need to find places where we can make room for others.
Okay, speaking of the small caps, what are you liking? You now have a full team behind you that can help you research, the small micro end of the market. What are they finding?
Oh, we're actually finding quite a lot of opportunities. As I mentioned before, they're cheaper, they're undiscovered, and they have a lot of catalysts coming. Usually the smaller end, what's exciting is that, you discover the company, and then you have next wave of investors discovering the company. And then you have all the index inclusion catalysts. So, you get a bit bigger, you get into the small ordinary. And once you get into small ord, you get more people getting interested, and then you have more brokers to cover, and then and then there's that sort of great momentum cycle. Then you get an ASX 200. Then you get, so they just have so many little catalysts coming up for those companies, which is very, very exciting. Of course you need to find the right one, the one that does have that moat about it. So we're finding lots of opportunity. But this company we actually bought in the IPO. When we bought it, I think a lot of people didn't want to touch it because even though it was cheap, it's Cuscal.
What do they do? Never heard of it.
Yeah. So the code is CCL. Still not yet got into the index because it's still liquidity is very, very low. So this company is essentially owned by a group of regional banks. Pretty much outside the top 4 or 5 banks. It's owned by these, and it was formed essentially to provide the back-end payment processing capability. So then it evolved into most of digital payment. They get a clip, so they provide all the back-end processing for those digital payments, of course just outside the big 4 banks. And so it's growing really, really fast. And then this company was floated by the regional banks, and then because they can't hold, it's not capital efficient, so they floated parts of it, and it listed at 12 times earnings, and listed at $2.50, and the share price I think just checked to $3.90 now.
Oh, wow.
And listed in December last year. And it's just a little company that has a really good niche, and then it has a really good growth driver underneath it. So it's been growing at double digit. And then there's a lot of acquisition opportunity as well. Just made another acquisition. It's like more than 20% accretive. So it's sort of been just proving to investors it could do it. And this is, real good business. And we just noticed the share, there's a lot more interest from institutions. And then we also have many more demands from investors demanding more sell down. Then you have more liquidity. Then it'll get into the index and it will continue to grow. And it's not expensive for double-digit growth because it's really hard to come by the growth that's at reasonable value.
On the other side of that, obviously there are some riskier companies in the small cap index and definitely in the micro cap part of the market. Are there any stocks that you feel like investors should be a little bit wary of?
Yeah, that's a really good question. Now, I probably won't name names, but we can talk about the in general. At the moment, one of the hottest sector is defense. I think previously we spoke about DroneShield and others, and they are actually kicking goals. They're getting contracts, actually many contracts now. The whole row of contract coming through, and then they're building their facility. I think they're doing really well. But on the thing is, it's that flow-on effect, the entire space, that anything that has potential defense in it has done incredibly well. More recently we noticed there's a lot of concept stock in this sector. They are in the micro cap end and they raise a lot of money, for a concept, as in they haven't got any contract, they haven't got any promising thing. But the things they may well be, but there are many of them. So they're bound to be a couple of them that's kind of won't pull through. So just be mindful when there's a hot space, because you're paying a lot for what the future contract might look like, and especially if you don't have one, it's just harder to put the valuation on.
I know, like when we spoke a few years ago, you were super bullish on DroneShield, but you don't own it anymore. Why don't you own it anymore?
Well, I think that's the thing. I kind of, it's one of the seller's regrets. When share price goes up like a hockey stick, I tend to feel, we got to take some profit. Look, I think the company has proven to be a lot more contract than I expected, and it's been incredibly strong. I think he's done a really good job. My view is that I do feel, there is a lot of hot money in this company and in the whole space, and just adding a little bit too much to the volatility. And then we sort of took over time, and it just, once you take profit, it's a bit harder to go back in.
Yeah. That's quite an interesting thing. That's kind of like a behavioural bias, though, because once you told me that every day you should be looking at your portfolio with fresh eyes, and if you wouldn't buy something today, you should sell it. But I guess on the other side of that, if you would buy something fresh today, I guess you should buy it, right?
Yeah, absolutely. So I think the challenge for people like DroneShield and others is that it's not trading on fundamental anymore. So if you talk about how much earning they can make based on the assumptions, they are very, very, very expensive, and we don't know. There's a lot of unknown. You have to make a lot of assumptions about how much market share they will take, and whether their technology, their investment is sufficient competing with globally what's been happening. So I just think there's a lot of assumption you have to make that's outside my expertise.
No, fair enough. You spoke before about, I guess, REITs. How about like more of the infrastructure spaces? I know obviously AI is a very hot topic at the moment. We've seen, interestingly, NextDC not do that well over the last year, but it has done very, very well over the last 6 months. I know you've liked Goodman Group as well in the past. What are you seeing in terms of like the more infrastructure related REITs or real estate plays?
Yeah, that's right. So I think that whole space, now that we've just been confirmed, every tech company that reports just confirm how much more money they will spend in the data center. You're right. In Australia, there's Goodman Group. You can get direct exposure, which underperforms significantly. So that potentially represents opportunity. Your NextDC is the one that's probably more direct. There's another little one that's coming up, which is Infratel, and it just has been added to the index as well. So it's now gathering a bit more momentum. I think it's quite a big part, a third of its book, or maybe even 40% of its book are now linked to data center. And the rest, some are renewable, some others. Management is very, very strong. They do this venture capital, private equity type of style, the style of running of the business. That one looks very interesting as well. We started going a little bit smaller. I think Megaport is the one that I remember we spoke spoke about it before. This one has really
I think I
turned
still
the
hold
corner.
Megaport. I've owned that
Oh,
for
it's coming
years
back.
now.
It's coming back. So this is one company that we did pick up. We bought more during the reporting season. Share price initially when result came through, they said, look, we're going to spend more money next 12 months. And share price went down 10%. And then we stepped in. The reason they're spending is because they just couldn't meet demand. And you want to see growth company to do that. The company is playing right in that right spot. And every measuring point, they have ticked the box, and then they're accelerating. So it's really turned the corner now. I think under the current CEO, it's going to continue to grow.
You've talked about so many stocks today. Thank you so much, Jun Bei. I want to end with like a really exciting growth opportunity. Whatever you may think is like the most exciting growth opportunity on the ASX today. It's a hard question. I'm sorry in advance.
Well, we still have to put it down to Life 360. I think this company is still at the tipping point of, next stage of growth. There's over 80 or 88 million people, active user every single month. It ranked really high in the US compared to other social media platform, and its users very engaged. I use it myself or my kids. I use at least 3 times a day. Checking where they are. And then getting alerts and updates. And so tracking is a big business. And this company has really proven, even though there's Apple, Find My iPhone, Apple,
Find
and
My
others,
Friends,
Find My Friends, and all of that. This is different because it's across the different platform. Whereas Apple or Google and others, they would like to keep it within their own environment. And then it's not about making money; it's more about keeping people within their own environment. For this one, they have the highest user. They launched before Apple did, and that they just really has been really resilient, if anything, growing faster. So now they got such a big base, and that they just at the beginning of trying to monetize that. So they started, monetize by charging a little bit of fee, for the user, and that's been growing. And then at the same time, they started testing out the potential advertising opportunity. And they gave a few examples compared to the Ubers and others. Given how engaged their user normally are. The potential is phenomenal. So I think this company is still the most exciting growth story, aside from Prometheus, of course.
Long-time fan. Okay, I feel like you've talked about a lot of stocks today that have run exceptionally hard, then also some opportunities that are just coming up. I know you love behavioural economics. Do you have any tips on how we can manage our biases during this crazy time, this new bull market?
I think the bigger in the bull market, your bias is always that you want to go for it, right? You want to buy. I think it's always about taking a step back and really understand what you're buying. I find my behavioral bias usually works, in the heat of moments. When you see the share price going higher, you want to buy more. And when the share price goes lower, you want to sell more. That's kind of heat of moment. Take a step back and working out what's being priced in the news information. Be rational. I think ultimately we just want to be rational. People will sell down the share price by 20%, but it may be a 5% earnings downgrade. And maybe this is actually an opportunity. But if you can't be, rational, you won't be able to identify that. So I really think whenever there's a big price move, I always see it as an opportunity. It's actually really exciting. Recently, the recent reporting season, we saw many of them. Some of them, maybe you have to wait, may take you 6 months. But look, as an investor trying to find treasure, you can wait 6 months, but don't put your whole basket with these sort of companies. The small part of it should be companies that's being left behind.
Okay, well, thank you so much for your time today, Jun Bei. I really enjoyed chatting with you about all your ideas today. I hope you enjoyed that podcast too. And if you did, don't forget to head to equitymates.com to learn more about investing.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.